Cryptocurrencies are all about decentralization, individual control of our assets that no one can restrict or seize. Yet it's always baffled me why seemingly decentralized assets are overwhelmingly being traded on centralized exchanges. Nowhere is this more prevalent than on the crypto derivative and margin exchanges. Now, people think that there are no real decentralized alternatives, and even if there are, they require a PhD to operate. Well, that was until dYdX opened their protocol. My name is Guy, and in this video, I'm going to give you everything you need to know about dYdX. I'll also take you through the process of trading, lending, and borrowing on dYdX, as well as comparing it to some other DeFi dApps. Oh yes, and be sure to watch till the very end if you want some of my top tips when it comes to trading on dYdX. Now, a quick few things before we get going. Although I am a crypto guy, I am not a financial advisor. Everything I say in this video is to be used as a supplementary educational resource. You should be aware of the risks. And if you just happen to be strolling by, welcome to the Bureau. Here's a pro tip: you may want to hit that subscribe button and turn on them notifications. This way you can get all my latest vids the moment they hit the tube. You done? Groovy, let's move. So, what exactly is dYdX? Well, simply put, it's a non-custodial decentralized crypto exchange, or DEX. However, unlike most other DEXs, here you can lend, borrow, and trade on margin. It's an open source trading protocol that was built on the Ethereum protocol and is powered by smart contracts. Now, given that it's non-custodial, it means that no one else but you are in control of your private keys. Trading is done by connecting your Ethereum wallets to the exchange. No KYC, no limits, no questions, no regular BS. It was started by some pretty smart folks back in 2017 who raised over $10 million in seed funding from some well-known VC funds. I'm talking the likes of Andreessen Horowitz, Bain Capital, and Polychain Capital. It went live in May of 2019 and has grown considerably since then. Take a look at the growth of funds locked up here on DeFi Pulse. There is currently just under $19 million locked into the protocol, and it's the 8th most used dApp, just ahead of the Bancor protocol. There has also been over $200 million that has been traded on the protocol. Not bad for less than a year. So, why so much growth for dYdX? Well, this comes down not only to its functionality, but also its relative simplicity. An ideal mix for adoption from the broader crypto community. Let's take a look at some of these features, starting with their primary MO, margin trading. As many of you will know, trading on the margin means increasing the size of your exposure to an asset through leverage. At the large centralized exchanges such as BitMEX, the exchanges will loan you a position in an underlying crypto for only a small deposit, margin. With a leveraged position, your gains and losses are magnified by the leverage factor, so pretty straightforward. Now, at a centralized exchange, they will monitor your positions, and if they deteriorate to a certain level, then you will be liquidated. This is all done by the internal liquidation engine that these exchanges run. Of course, you can't see how these engines work, and you don't know all the parameters that are used in those algorithms. At dYdX, on the other hand, the protocol is open source. Fully auditable smart contracts adjust leverage ratios, free up margin, and, if need be, liquidate positions. You can see exactly how the protocol works in a fully transparent manner. Anyways, leverage at dYdX goes up to a maximum of 5 times, or an equivalent margin position of 20%. Now, I know what you're thinking. Guy, I can get up to 100 times over on BitMEX. Well, yes you can. But do you really need 100 times leverage to be profitable? Let's not forget that leverage is a double-edged sword, and you can lose just as quickly as you can gain. And is the benefit of trading with so much leverage worth the risk of trading against such a black box? I leave you to be the judge of that. But 5 times leverage on a decentralized exchange is pretty sweet for most traders that know what they're doing. Also, with lower leverage, you have less risk of liquidation. Anyways, another really sweet feature that you have at dYdX, you have 2 types of margin mechanisms. You have isolated and then you have cross margin. Isolated margin is the mechanism that you're most likely to be quite familiar with. It's where you will isolate a particular amount of your funds as part of a trade with a specific leverage level. If there is a liquidation, the losses will be capped to your isolated position. However, cross margin is something different. This utilizes all assets that you have in your account. It takes into account your combined position in your account when it is determining leverage and limits. There are a number of reasons as to why you may want to cross-margin your trades. I won't go into all of them here, but I have linked to a number of resources below that take you through it. Anyways, when it comes to trading pairs, you have ETH-DAI, ETH-USDC and DAI-USDC. That last one is actually pretty cool. You can trade the difference between a centralized and decentralized stablecoin. Oh, for those of you who don't know what the DAI stablecoin is, be sure to check out my handy video on that right over here. And while leverage trading is one of the selling points of dYdX, don't forget that it's also a standard DEX. You can trade the above spot assets in the spot market. A nice touch. Now, the next feature that I want to talk about on dYdX is their lending feature. So let's move on to that, shall we? When you're lending your crypto out on dYdX, it's being lent out to other users on the platform and you are earning an interest on that deposit. This interest is earned on a continuous basis and is sent straight to your wallet. This is also relatively risk-free lending because the dYdX protocol ensures that the borrowers are over-collateralized. What do I mean by that? Well, they have a collateralization ratio that requires more crypto collateral than they have borrowed. This means that if the market was to move quickly, there are enough funds to pay back the lenders. Another really sweet thing about dYdX and DeFi lending dApps like it is that there are no restrictions on the deposits. You can withdraw the funds lent whenever you like. The concept of a term deposit is alien in the crypto space. And given that this is a decentralized app, there is no entity or intermediary that's controlling your lending. It's all managed through the use of transparent and decentralized smart contracts. This makes it quite different from other crypto lending platforms such as BlockFi or Nexo, etc. Anyways, the final primary feature of dYdX is the ability to borrow. Part of the reason that dYdX can operate a leveraged DEX is because of the global lending pools facilitated by the protocol. These pools apply to a particular asset and are all operated by smart contracts. Now, supply and demand in these lending pools will determine what is called the utilization ratio. This is basically just the amount of funds that are utilized in the lending pool, so borrowed amount divided by supplied amount. This will have a direct impact on the interest rates that are being charged or earned. It's actually pretty ingenious. The same happens in traditional financial markets. Interest rates are seen as the cost of capital and they move according to how many people want to borrow a fixed portion of capital versus those who want to supply it. That aside, borrowing on dYdX can be done up to a minimum collateralization ratio of 125%. Anything below this level and you cannot borrow any more crypto. And once that crypto hits 115%, your trade will be liquidated. This is in order to keep the trading pool solvent and keep the lenders that we talked about earlier whole. Those who are liquidated will have to pay a liquidation fee of 5%. This is done in order to make sure borrowers keep their accounts well collateralized and firmly above the liquidation level. Okay, so now you have a reasonable overview of the main features of the dYdX platform, but how in the hell can you use it? Well, it's actually pretty damn simple. So simple, in fact, that you can even be forgiven for forgetting that it's a DEX. From the homepage of dYdX, you can select what you want to do: trading, borrowing, or lending. For me, I'll be trading right now, so let's hit that. Here is the main dYdX user interface. Super clean and intuitive. It's pretty well laid out and looks much like your typical centralized cryptocurrency exchange. Here you have your order forms, your order books, the buy-sell walls, charts, open orders and positions, etc. It's actually pretty neat that they've included this trading view chart here, as this will allow some of you more technical traders to run your TA. You can also switch the chart here to view the market depth. Anyways, in order to trade on dYdX, or any DEX for that matter, you have to connect your wallet to the dApp. You can choose from any wallet here. You can connect your ledger if you want, but I'm going to go for my MetaMask. Once that is done, you'll need to approve the transaction on your device and you're ready to go. Like with any exchange, you'll need to deposit assets in your account. So let me do that right now. Given that you also have that lending component, you should note that the moment you deposit funds at dYdX, it will be placed into the lending pool and you will start earning interest. More on that below. Give it some time for the network to process the transaction. Once it's fully confirmed and deposited into your account, it will be reflected over here on your balance. Now you're ready to trade. Given that we're going to trade on margin, I'm going to select that one. Going to go long on ETH-USDC pair over here. Here you can choose the position size as well as the leverage. As mentioned, your max is 5, but you can set a custom leverage limit if you want. When it comes to the advanced options here, you can set your max slippage. This is basically the maximum amount that you will allow the price to fall and would still be happy executing the trade. If the price slips past this max slippage point, then the order will be cancelled. Oh, quick note on this expiry time point over here. dYdX trades are not perpetual. You can think of them more as regular futures that have expiry times. So basically, once you reach expiry, the position will be automatically closed out. Anyways, once you're fully comfortable with the parameters, then you can place the order and it will go into the books. You'll be able to monitor your trade over here in the Positions tab as well as your P&L. You also should keep an eye on that collateralization ratio. If you slip below the liquidation point, then you'll have your position closed and lose that liquidation fee. Anyways, that is the margin trading feature. You also have spot trading, which is the next thing I want to take a quick look at. This is much like the other standard DEXs that you'll have seen. You will technically be swapping one crypto for another. You also have a lot more order functionality than you do on the margin trade. These include placing market orders, limits, as well as stop orders. You can also select how long you'd like the order to remain open. It's time in force. So a bit more customization options around your orders here. Do note though that if you have any leveraged trades open, trading in the spot market will impact on your margin and in turn collateralization ratio. So keep an eye on that one. Now, when it comes to lending on dYdX, it's pretty simple. As mentioned, the moment that you deposit crypto onto the exchange, it will start earning interest. You can see those interest rates over in your Balances tab at the top of the platform here. Here you will have both the lend and the borrow rate on the various assets. You should also note that dYdX will take a 5% cut of all interest payments in order to fund an insurance pool to protect the protocol. This is already reflected in the rate here. These rates are annual percentage rates but are paid continuously into your wallet. All clear? Cool. To complete this walkthrough, let's take a quick look at the borrowing feature, shall we? Here at the top is the tab to borrow funds on dYdX. It's a pretty straightforward layout. On the left here, you have all your asset balances. Here you can repay outstanding balances, and over here you can borrow new assets. Then right over here in the center, you have all your outstanding borrows. Borrowing crypto is pretty damn simple. All you need to do is select the crypto that you want to borrow. Choose the amount you want to borrow as well as the crypto that you'll be depositing. In this case, I'm looking to borrow some DAI and will be depositing some ETH. I hit Borrow DAI and confirm the transaction on MetaMask. Now you will see the outstanding borrow show up over here in the center as well as all the interest rate that you'll be paying. Pretty slick, right? That does it for the platform walkthrough. So let's take a look at something I'm sure you're dying to know. Fees. Now, up until pretty recently, it used to be free to trade on dYdX. You would sign a message to create an order in the book. When those orders were matched, dYdX submits a transaction to execute the match trades on-chain. dYdX would have to pay the gas costs for this transaction. Now, while this works smoothly with smaller trading volumes, as volume picked up this year, so did gas costs. In February of this year, they had to fork out over at least $40,000 in gas fees in order to cover it. So there was a change in March of this year where they announced that they would start charging fees in order to cover this cost. The fees that are being introduced will follow a standard maker-taker model. Essentially, those who are making markets and providing liquidity will get a lower rate than those who are taking it off the book. In the case of dYdX, makers will have zero fees and takers will be charged a few percentage points. You can see the breakdown here. Do note that there is a different taker fee for those who are trading less than 0.5 ETH. This is only logical as gas fees on transactions for small orders are just as large as those of larger orders. Anyways, if we were to compare these fees to some of the larger exchanges such as Binance, the taker fee on orders above 0.5 ETH is slightly lower, whereas it's higher with orders below 0.5. Still, pretty damn impressive for a decentralized exchange. In terms of any other fees that you could have to pay on dYdX, you have that liquidation fee that I mentioned above, and then if you allow the trade to expire, it will have to be traded. This trade carries a 1% price spread. All in all though, I think that these fees are reasonable and are the cost of maintaining a secure and highly functional DeFi protocol. Moving on though, are there any developers out there? dYdX has built a pretty simple client and trading API that will allow you to build trading bots. So, much like you can build bots that interact with the large centralized exchanges, you can develop them here to trade on-chain at dYdX. Except, when trading at dYdX, you can place instant non-custodial trades. There are also a number of other benefits that can come with building bots at dYdX. Not only can you programmatically partake in the margin trading, but you can also run a liquidation bot. So what the hell is that? Well, at dYdX you can also participate in the liquidation of under-collateralized positions. Doing so earns you that 5% liquidation fee that I mentioned above. If you're running a bot 24/7, you can basically scan for these under-collateralized accounts and take advantage of them when the moment arises. dYdX have even provided the code for an open source liquidation bot which I've linked to below. I've also linked to the developer docs that have all the other info you need to build these trading bots, so be sure to check them out. One of the final few things I want to look at is the competing DeFi projects dYdX is up against and how they compare. Let's pull up that DeFi Pulse ranking chart again. As you can see, there are a number of other projects ranking higher in value locked than dYdX. The top three are actually quite interesting: Maker, Synthetix, and Compound. Maker is Decentralized Autonomous Organization, or DAO, upon which the DAI stablecoin is built. Since the issuance of DAI, it's become the most popular decentralized stablecoin on the market. There was also recently an upgrade of the ecosystem to the multi-collateral DAI. I won't go into the details here, but if you want a more in-depth overview, be sure to watch my video on it. But basically, this is also a lending protocol that has got a decentralized exchange feature as well. This is all done through the Oasis DeFi Hub. While the lending and borrowing features are pretty straightforward, the trading feature is left wanting. It's pretty basic and is way less advanced than dYdX's. Just after Maker is Synthetix. This was another really exciting project. It's basically a decentralized trading protocol that allows crypto traders to take positions on synthetic crypto assets. It does not only have to be crypto, but it can also include a number of traditional asset classes. You can also trade inverse assets, which would be akin to shorting a pair. If you want the whole lowdown, I have a video for you. Now, there is no doubt more trading optionality than dYdX. You don't have margin trading. I also find that the trading interface is pretty basic when compared to that of dYdX. Of course, some people find it simplistic, which is a plus. Finally, you have Compound Finance. This is a lending protocol that has also been making waves recently. It also has a pretty sizable lending pool, as you can see over here. Apart from the size of the lending pool, you also have much more optionality when it comes to lending and borrowing. Something that I thought was pretty neat was the wrapped Bitcoin lending. This basically means that you can lend an ERC20 asset that tracks the price of Bitcoin. Cool, right? Of course, you can't trade on it like a DEX and you don't have margin trading optionality, so it won't really satisfy your needs there. Anyways, want more info on Compound? Yeah, that's right, there's a video for that. That's the end of my dYdX review and overview. Time to leave you though with some of my final thoughts. I really like what the team is doing and they have built a pretty effective DeFi dApp. It's pretty easy to use for most crypto traders used to the large centralized exchanges. The simplicity does not come at the cost of reduced functionality. Lending, margin trading, borrowing and liquidation are all part of the dYdX package. While the recent introduction of trading fees may disappoint some of the earlier traders on the protocol, it was always expected. Upgrades take time and developers got to eat. So I would recommend giving dYdX a try if you haven't already. Of course, be sure to manage your risk and never trade, lend or borrow more than you can afford. I'm sure your financial advisor would say the same thing. But now it's time for you guys to do the talking. Any thoughts on dYdX? Have any questions for me? Hit me up in the comments below. Also, if this video tickled your fancy, then tick that like button and don't forget to subscribe. Much more will be with you soon. Before I leave you, there is something you need to know. Oftentimes I have so much more info that I want to share, but time sadly escapes me. This is exactly the reason that I've started my weekly newsletter. One email every week that summarizes and crystallizes everything that's on my mind. Market moves, unreported news, and hidden coin views. So, do you want to be a part of it? Alrighty then. Simply go to the description below and find the sign up link. All you need to do is fill out your email address and hit submit. That's it. You may just be in time for my next email, which includes a hidden coin tip which you really don't want to miss.